Hello and welcome everyone. I'm Andreas M. Antonopoulos, the Bitcoin and open blockchain expert, and I have with me today Kirk David Phillips, CPA and CVP, and we're talking about the IRS safe haven rules. These rules that take effect January 1st and require action before the end of the year. It's a very important topic that I found out about by reading the Crypto Bullseye newsletter and blog that Kirk has been publishing for quite a while now. You can find more information at cryptobullseye.zone. Kirk, welcome, and thank you so much for helping us understand this complex issue.
Thank you so much for having me here. Yes, this is a very, very important topic that many people need to get to become aware of as soon as possible here because of the short deadline to take action.
Right. So we have 2 weeks. As we're recording this is December 15th. And we have 2 weeks where people actually need to do some things to be prepared for this. And so we're going to talk about what the IRS safe haven rules are, what implications they have, and what exactly people need to do in the next 2 weeks to be prepared for this new rule, and also what the consequences are if people do nothing, right? What kind of problems might arise. So why don't you kick it off and tell us what the IRS safe haven rules are and what people need to do in the next couple of weeks.
Sure, absolutely. So first of all, let's just take a step back to a further point in time where all this stuff originated from. So within the last couple years, there have been some bills that have been bouncing around U.S. Congress that are called the digital asset broker rules. And those actually became final in 2024, somewhere around the middle of the year. So those digital asset broker rules are basically requiring digital asset brokers, which are mainly centralized exchanges, okay, but that could be expanded more broadly than that. But right now, as it applies, think centralized exchanges when we talk about digital asset brokers. One of the concerns with that definition originally was that it was too broad and it was basically a net that was being cast to even capture self-custody wallets and things like that. So anyway, that's a deeper conversation, but nonetheless, right now we're talking mainly about centralized exchanges. So we can think about anybody right now that has any traditional brokers, whether that's a Fidelity or a TD Ameritrade, any of those type accounts, which where you could either have a broker that helps you with your activity, or it's a self-guided account. But nonetheless, especially in the age of where you can have your own account and you're provided with all kinds of tools. But if anybody that has any activity that has to do with traditional securities that is aware that they get a 1099-B from U.S. Treasury and the IRS. So what is a 1099-B? Well, a 1099-B is a statement that lists all of your trading activity. So all of your sales, whether it's stocks, bonds, or any other type of traditional assets like that, it lists all the sales. And in most cases where the broker actually has your detail about your cost basis, it reports that too. So it's how much you sold it for, and it's what you bought it for. And the difference between those is going to be your gain and loss. Now, the broker doesn't always have the cost basis information, so it may just be the proceeds part of the equation. But many times they have both of those. It will report gains and losses. It may even summarize those for you, so where it will have both short-term gains and long-term gains summarized. And also in the 1099-B, it would also include dividends, interest, and other types of income like that. All right, so that is what the intention.
Question there.
Sure.
Just for my own edification, I don't really know about this much. I get a 1099-B from my investment retirement account. Okay, so I do know that in crypto we choose a cost basis method, such as FIFO or perhaps something else like HIFO. What do they use? Is it always FIFO?
That is
Do
an
you get
excellent
to
question.
choose?
That's an excellent question. We're actually going to get into that.
Okay,
As
great,
we
great.
go along, we're going to get deeper into that. But yes, so right now, when we talk about TradFi, you've got two things that you can use, which is FIFO, first in, first out, and specific identification. So we'll talk about that later. Now, in this scenario, the brokers would actually default to FIFO unless you instruct the broker specifically, instruct them that you want to follow specific identification. And if you were to do that, then they would not take any action on a trade until you tell them the specific lot. Yes, it's this lot, meaning whatever ABC security that I repurchased at this time for this cost basis, that's the specific one I want to sell, I mean. So if you don't tell them what it is, they're not going to take any action because you've already left them with a standing order that says, I want to follow a specific identification. So that's great because we can tie into that later. So anyone who gets a 1099-B statement, that's a great segue to tie in that the intention of the digital asset broker reporting rules is to basically wrap all of that around crypto so that the same exercise happens in crypto and you get a 1099-B that shows up with your crypto asset activity on it. However, instead of a 1099-B, they've created a special name. It's called 1099-DA for digital assets, but essentially the outcome is the same so that all this stuff is reported. Now, why do that? Why go through that exercise? If you were to assume that everyone was to self-report, because there's many things related to tax-free self-report. Not everything is reported on a third-party statement. Well, the number one reason for it is there's a thing that's called the tax gap. So what is the tax gap? The tax gap is the difference between what U.S. Treasury thinks is the revenue that they should collect and what they actually collect. And there's hundreds of billions of dollars that are estimated to be the tax gap, which means revenue that's left on the table that they don't collect, and that's for various different reasons. And again, there's a huge portion of revenue that's self-reported. So, for example, business income and expense. You manage all of the revenue in your business. You manage all the expenses, and you report that. There's no record. There's no third party that reports any of that. So that's one example where you are voluntarily reporting everything that happened around that particular business and so on. So, and now on the other hand, some things like a W-2, well, in that particular case, the employer files a W-2, and then you as the taxpayer, you file your tax return with that W-2 information, and that allows the IRS to match, and they're looking for it to match up. So that's why they like third-party reporting. When you have third-party, if everything could be third-party reported, in theory, the theory would be that you close the tax gap down to zero or approaching zero. Okay.
Right.
So the perception here is that there's a gigantic portion of the digital asset and crypto user population that is not reporting, and they think that the tax gap is so large that we need to close this tax gap so that we can collect the revenue that they think they say we're entitled to based on the laws. So that's where all this originated from, is to now wrap 1099-B reporting for traditional securities around crypto. But again, it's called now 1099-DA. All right. Now, there's a lot of things that are going to be in transition with this that we don't know yet. But like I said, this basically applies to centralized exchanges. Right now, it does not apply to DEXs or decentralized exchanges. Let's say the jury is out on that at this time, but that's where we're at right now. So what happened
All right.
is...
So let me ask a follow-up question. So I think at first glance, people might think, okay, this doesn't really affect me. I'm already reporting and paying my taxes on crypto, so I'll just continue doing that. And by reading your blog newsletter, I understood that that is in fact not the case, that it very much does affect you.
Correct.
I can say comfortably that I do report my crypto capital gains and have done so ever since the beginning, because I would rather enjoy those gains from outside a prison cell. And the IRS has a tendency to take that route. In fact, I was reading an article just yesterday of someone who ended up really pushing the boundaries and trying to not pay a dime while buying houses in the US and things like that. And they're currently serving a 2-year prison sentence in Texas. So So I am reporting my capital gains, and let's say I use a traditional centralized exchange, and but I do my own custody. I don't keep my crypto or my Bitcoin more specifically on that exchange. So normally, as I recommend people do, you send the amount of money you want to exchange, you exchange it, you sell it on the exchange, and then you take the US dollars or euro or whatever out, and you don't leave things on the exchange, and that's how you should behave for self custody. Now, at the end of the year, this exchange is now going to have to do a 1099-DA on my digital asset sales, and they have no information on my cost basis. In the past, I simply ignored their 1099 and I produced my own reporting form, which is a 89, what is it?
8949.
An 8949, right? Where I report for each one of those things the cost basis, and I use a piece of software to do that. What I understood is that is no longer going to be enough, or it's not as straightforward as that. So let's go into that a bit. So even for people who do not um, keep their money on an exchange, who do self custody, and who do report their crypto gains and pay taxes on them, this has some rather significant implications. What are those implications? And why
Correct.
is it we need to take action?
Correct. So to just fast forward and tie this whole thing together. So as a result of these digital asset broker 6045 regulations becoming final in the middle of the year, as a result of that, what happened is as a surprise and out of the blue came the subject of today's talk, which is IRS RevProc Revenue Procedure 2024-28, which is simply transitional guidance. So they said that you have to do, this is how this is going to happen go forward. And as a result of that, you got to make this one-time transition to facilitate as a tee up to what's going to happen going forward. So the key takeaway here is, and this does affect everyone. It doesn't matter where the assets are, self-custody, centralized exchanges, doesn't matter how you use it, what assets you have. This applies to everyone to have to go through this exercise. Now, maybe a lot more work than others. But the number one takeaway here is that what has been taken away, which as you explained, using the software in the past. So the way that all software was designed is to account for your crypto under the universal basis. So universal method has now been eliminated. So now you are going from a universal method to a wallet by wallet or account by account methodology. Now, universal
Let
is,
me see if
yes,
I understand this correctly. What the universal method is, and I can use my experience to describe how I experienced this. So in the past, what I would do is I would go to one of these software platforms, usually web-based platforms, and I would link them to one or more exchanges that I have trading activity on, and they would suck all of the transactions and put them in. At the same time, they would have previous transactions from years earlier when I originally bought those, or I've manually entered the price at which I bought some of those things. And then and this is the key, the universal basis. They throw all of the transactions from all of the wallets and all of the exchanges into one big bucket, right? And then when I tell them use this method for calculating gains, first in, first out, or highest price first out, or LIFO, or whatever other method you can pick from the dropdown, they do that across the entire bucket of transactions, regardless of whether I bought on Coinbase and sold on Kraken. I bought from a private individual and sold on, Coinbase or whatever. So I could basically say the thing I'm selling on Kraken gets matched to the thing I bought on Coinbase or the thing I had in my wallet from another source, even though I also have things I bought on Kraken and left on Kraken and now I'm selling. I can say, no, it's not that one I'm selling, it's the other one. that has a more advantageous cost basis for me, and I could just basically pick and choose from the bucket, or rather the software could. And you're saying that is the thing that's no longer allowed?
That is correct, and that was an excellent analysis.
Okay.
You know, that's exactly what it is. So what I like to say is that universal method is as if. So if Bob has 37 wallets and centralized exchange accounts, it was as if all 37 were dumped into the same bucket, exactly as he described. It's as if you had one Coinbase account or you only had one Kraken account. It's dumped together for one universal accounting, as if. So all the for transactional purposes, it's as if you had one wallet. So that's it. Yes, that's correct. That's what's been eliminated. So what happened? So
Okay,
now,
hang on a second. And this is the idea of a one bucket that exists virtually, that virtually consolidates all of these different wallets into one entity. What if you actually have one bucket? What if, and just to understand, this doesn't mean that you can't have a wallet, a single wallet, that is the place you took all of your crypto. So if you have, let's say, a hardware wallet, and you bought a bit on Kraken, and you bought a bit on Binance, and you bought a bit on Coinbase, and you withdrew that money and you put it in your own self custody, you literally put it in the same wallet. And then later you took it out of that wallet and you sent it to an exchange. I don't know if I'm sending the same UTXO that I withdrew from the other one. It went into the bucket. At that point, have they also eliminated that being considered as a universal, that actual single bucket?
well, that is, yeah, if you actually have right now one hardware wallet, for
Yeah.
example, and like I said, you examples like you purchased it from 3 different exchanges, whatever, and some other
And I
source.
didn't leave it there. I took it,
Right.
I withdrew it
Yeah.
to my own personal custody and mixed it with all of the other
Yeah.
coins I have. No, I didn't mix it. I just deposited it in my own wallet. Yeah.
So in that example, that's actually the other end of the spectrum than the scenario I was making up with where Bob has 37 wallets and exchange
Right.
account. Now you have one.
Yeah.
So in that case, yes, it's universal, but it just so happens that it's a unique situation where it matches 1-to-1, where the hypothetical or the virtual transactional accounting of it happens to magical the physicality of it, if you will, where the
So
coin's
that's
actually
still
stuck.
okay.
Well, that's yeah, that's okay. Now that doesn't mean you don't
Okay.
go through the exercise that we're going to talk about,
Very
but
good. Okay.
what you've done is you've eliminated some of the work that you would need to do to make this exercise more palatable and to set you up for better success in this allocation exercise. You happen to have just set
I,
yourself up by accident for,
I'm
let's say, the
glad to find
scenario.
an I'm glad to find another silver lining for self custody, because for many years it's been all burden, right? So, being able to say that actually in this particular scenario, self custody makes the accounting a bit easier. Well, let's, but it still doesn't eliminate the need. Okay, so let's go back to what you were saying. So you're Bob and you have 37 exchange wallets, actually distinct, that you don't withdraw back to a single source. And in the past, when accounting for capital gains, you use software that made it appear as if they were all one universal virtual wallet, the money could come in and out, and that's no longer allowed. So what happens now if you're in that scenario?
Right. So what happens now, first of all, is what I like to say is the IRS just tripled your tax prep costs and created an absolute nightmare. But that's 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 really
Right.
what happened. So the issue is it was already challenging enough to go through this exercise. Anybody that's in crypto can tell you that. The best person to manage it is you. And it can be extremely challenging even to do it and to come up with the, let's say, the best result, an accurate result. It can be extremely challenging, especially if you're on the degen end of the spectrum here. So now you're the best one to do it. So now you've been relegated instead of so basically universal accounting is a single accounting. Okay. Now Bob has 37 different sets of accounting. That's what he's been relegated to.
So in practice, you're doing a separate 8984 matching of purchases and sales for 37 different wallets.
It
You
could
you
be
you
that, yes.
you
Yes.
you're almost back to specific, what we call it, um specific allocation,
Well, specific identification. But I mean, even in
specific.
that case, regardless of whatever method you use, LIFO, FIFO, HIFO,
Mhm.
spec ID, universal still applied. So universal is not a cost basis method, by the way, because all these things
Yeah,
could be confusing.
right.
Universal is not a cost basis method like a HIFO or a FIFO. It's
It's the
just it's
context
the
that you
dumping
can
together.
apply. It's the context in which you can apply FIFO. So
Correct.
which transactions can I consider for the FIFO matching? Let's say I'm picking FIFO as my cost basis. Uh, First into what? First out of what? And with universal basis, it's first out, first in generally across all of my digital assets. Now, you're going to, let's say you've decided you're doing FIFO, you're going to have to do FIFO for one of 37 buckets, and you can only match FIFO within that context. And then you're going to have to do it again and separately for matching in other contexts. And therefore, the list of candidates you can use for, you're basically, let's say you're now doing the first out, the candidate that you can match as the corresponding first in transaction for that first out has to be from the same bucket and can no longer be from anywhere. Is that, am I understanding that
That's
correctly?
100% correct. Well explained. And then, yeah, so you've narrowed the field of candidates down to use it the
And
way
let
that.
me guess, none of the software does this.
Correct.
And this is where it gets really complicated, because
Correct.
if you do a lot of trading previously, the only way you do this is the software would figure it out for you. But now you can't do that because the software automatically throws it all into a universal bucket.
That's correct. We're going to get into that deeper
Oh
later,
boy.
software issue. So,
Okay.
yeah. So I think we've summarized it well. The key takeaways here, a universal approach has been eliminated. Now we're down to a wallet by wallet, account by account method. So I think most people would get right away that, oh wow, that the complexity just skyrocketed by like 10x. Choose your multiple.
Yeah.
How much the complexity skyrocketed.
Hmm.
So hence that's where a lot of the conundrums come in, is because you have this one, first of all, you got a one-time allocation now that you need to do. That's one thing, going through that exercise. After that, you then have the going forward challenge. How are you
Right.
going to manage this going forward into 2025 and beyond?
Okay, great. So let's talk a bit about this one-time allocation that you have to do now. So you're Bob, you have 37 centralized exchange accounts, and you're in the worst possible scenario. What do you have to do? What is the safe haven transition rule? So they made this rule to give us some guidance on how to transition into an environment in which the universal basis is no longer available to us. What is this transition rule or
Right.
transition
So
procedure?
basically, the transition rule gives you two paths to make a transition. So one of those is called the global allocation method, and the other path is called the specific allocation method. And let's be clear here that specific allocation is not specific identification. And again, this is one of those things where the terminology is similar and it can be easily collapsed, and you think it's one thing and it's not. Okay. Again, specific
Specific.
identification.
Okay, so let's deconflict this. So specific identification, which I spoke earlier. Specific identification is when you're applying the cost basis, you're essentially removing the fungibility. You're identifying a single unit of stock, bond, or crypto, and saying this unit is the one I just sold, and that's specific identification.
Correct. You're
So,
cherry picking, specifically cherry picking the one that you want.
right. And that is to the exclusion of a more generic approach for cost basis, which would be something like FIFO, where you're doing it based on the date, or HPFO, where you're doing it based on the price, whereas specific, you're simply removing the fungibility completely, and you're identifying each and every unit and matching them manually. Okay,
That's correct.
so specific allocation and global allocation are the two paths for the interim adjustment. All right, so what are those two options we have?
Right. So with global allocation is like a formula or a recipe is what I like to call it. So you would simply say, okay, I'm going to write this out, literally like a memo, a game plan type of a thing, a recipe, which says that I want to apply the oldest coins. I want to apply the cost basis for the oldest coins, the oldest ETH, whatever that is, ETH from a crowd sale, or oldest Bitcoin you got from way back from a long time ago. And I want to allocate those first in this particular wallet. And in a case, it may actually be where you have a self-custody hardware wallet with BTC that you got a long time ago. It's actually never moved. And it's very clear. I have this cost basis with that wallet, and that one kind of takes care of itself. So you might say, all right, that's how I want to do it. I want oldest coins and the cost basis related to that in this particular wallet over here. Maybe it happens to be the oldest wallet. Or you could say, I want the coins with the highest cost basis to be allocated over here in this wallet. So you create a formula. Now, the key distinction about global allocation is that if you take it, once you're done with that, if you take this recipe and you give it to 4 different people, Bob and Alice and Dimitri and Andreas, everyone will come up with the exact same result if they follow the formula, because it's formula based. So theoretically, 4 people have it, 4 people follow the formula, the end result should be exactly the same. With specific allocation, it's simply taxpayer's choice, or like you think of it, fielder's choice in baseball. He gets the ball, he gets to choose where he wants to throw the ball. You get to choose how you want to allocate, and the
Okay,
result
so
is different.
this is not a cost basis allocation like FIFO or HPFO or specific identification. This recipe is for grouping um, grouping assets into wallets. Am I understanding this correctly?
Yeah, the idea at the end of the day here, the takeaway at the end of the day is back to Bob and his 37 wallets is when Bob is done with his exercise, he has call spaces specifically assigned to each of the wallets. Whatever the assets are in the wallets, he is now assigned locked in call spaces for those wallets.
What does call spaces mean?
Call spaces.
Cost basis. Sorry.
Call spaces.
Yes, cost basis. He's locked in cost basis, and that cost basis transcend. So let's say you have 37 wallets, and you decide you're going to do a cost basis based on the oldest coin, right? Okay. Does that mean that you pick a cost basis for um, your Coinbase wallet? You pick another cost basis for your Kraken wallet, or you have to pick one cost basis and then apply it to all of the 37 wallets you have, so as to harmonize them. I'm not quite sure I understand
Yeah,
how you would
it's a
do
little,
this.
well, it's a little like in global, there could be a little bit, there could be, I believe, some mixing and matching you could do, but yeah, essentially you are simply just, again, it's assigning it by formula where anybody could calculate the same result because you're describing how you want to do it rather than actually doing it. So the specific allocation is simply, it's like moving chess pieces around, and I just want
Right.
to assign this over here and that over there, and so on. So
So if
it's
I
more
understand this,
granular. It's more
yeah.
granular. It's more work specific allocation. I guess another way to look at it too is with global allocation, it's more of a way to do it so that it's, I could say maybe it's not as much work to maybe
Okay.
simplify it rather than specific. When you do specifically, it might be more work because you're doing it on a more granular basis.
Understood. So basically, what the IRS is telling us is, because we're going to start doing this a new way where you won't have the universal basis, you have to commit in advance if you want. You're either going to end up with a scenario in which you have to do it 37 different contexts manually, after January 1st, 2025. So next year, if you do a sale, you're either going to have to say, this got sold on Kraken, therefore I have to find an equivalent cost basis within Kraken, or this got sold on Coinbase, or any of my 37 Bob wallets. I have to do it the really hard way, which is the only context that's allowed is that narrow context. Or in the interim, I can pre-commit, allocate cost basis now during this safe haven, which is now only 2 weeks, clearly allocate the cost basis now, commit to that, and from that moment on, I can then follow that pre-committed to cost basis going forward to simplify things. And the two ways I can commit are either with a specific allocation where I pick the cost basis for every single commitment I want manually, or using a recipe, which is basically an algorithm that, if applied to the same lots of digital assets, would always result in the same outcome, regardless of who applied it. So it's an algorithm, a mathematical algorithm, such as pick the oldest one, or pick the highest cost, or pick the lowest cost, or whatever. And I'm going to pre-commit to that, and then I carry that forward into 2025. So I don't have to do 37 different allocations.
That's correct. Yes, that's exactly it. Right.
Okay.
And so again, and the where I was saying that using the way you're describing it as an algorithm. So if you then in the specific allocation method, it will be basically, if you gave it to, using my same example, Dimitri, Andreas, Bob, and Alice, they're not going to come up with the same result
Right.
because the taxpayer
Specific
just did it however they
allocation.
wanted to do it. So
Specific allocation is a table, right? It's a table where you list all of the cost basis
that's right. Yeah.
per
So,
unit.
and you're just creating a starting point. Yeah. You're creating a fresh starting point that says, this is what I declare is in the wallets for the way that I now need to account for the way that now cost basis methods need to be applied going forward from here. So
Okay.
you're putting a stake in the sand to say, this is what it is. You're describing it. You're laying it out. And then that's your new starting point, fresh starting point going into the future.
All right. And so if you do nothing, you walk into 2025 completely unprepared. Come 2025, you go on any one of these centralized exchanges and you do a sale. They're going to issue a 1099 DA, and they're going to match it to one of their previous things that you did on their exchange, because they don't have any other way of finding out. And you're not going to be able to give it a broader context anymore because you don't have the universal basis. So one, you're going to have a complete accounting mess at the end of 2025 because you didn't proactively simplify it. And two, you're probably also going to not have an optimal calculation of your gains and losses, which means you may end up paying a lot more in taxes.
That's correct. You could set yourself up for, first of all, you have to do this anyway. Okay.
Right.
So the question is, what happens if you don't? And yes, you could create a mess because you didn't pre-plan. That's one issue by itself. But the other issue is that you have to do it anyway. So if you miss the deadline, you miss the safe harbor. And then the question is, well, what happens there, or what does the safe harbor get me? So, well, one of the things is we don't actually know what it means when we don't know what it means to be in the safe harbor. Normally that's spelled out, but again, as I supplied as a link with the AICPA's comment letter to the IRS on this, you'll see that actually kind of paints the picture as to, here's this rev proc, but yet here's all the unknowns, or here's the things where it's not clear. Here's all the gray areas. That's painted out. That's spelled out there. Okay. So what it should mean is that if by going through the safe harbor exercise that you have a force field that says that if I was challenged on any of my prior work, or if I was audited on my prior work, that it can't be challenged. That's like
Right,
the safe harbor is like a force field around what you previously done, and that sets you up. It's like a protection, an
right.
invisible protection.
So this is not just about your 2025 taxes. This is going to create problems for how you applied and reported the past 10 years of capital gains on crypto too. The safe
It could,
haven
yes.
protects you by wrapping that all up in a bow and saying, this is what I did, and here it is documented, so you can't say anything about it.
That's correct. That's what we believe it could be. But again, we don't know because
We're
that wasn't
hoping.
specifically laid out.
Well,
And
we
of
know
course,
that
it
if you
can
don't
also
do
protect you.
anything, it only gets worse, right? So
That's right.
I think what I'm getting from you is an unequivocal recommendation here, and please correct me if it's not. The unequivocal recommendation is do something while you're in the safe haven. There is no scenario in which simply ignoring this problem will be better. It will always be worse to ignore this and not do something. You have a unique opportunity just in the next 2 weeks to do something, and you will always be better off if you do this something than if you don't do anything. Is
That's
that an
probably one of the key.
unequivocal?
That's 100% spot on. That's probably
Okay.
perhaps one of the that's going to be maybe the number one takeaway of the day is that because as I said again, you still have to do the exercise.
You still have
So
to do
if
it.
you wait until later and you don't do it, you miss the opportunity for, let's say, this protection, this invisible force field, but then you
Right.
still have to do it anyway. So you didn't get
Right.
out of doing it and you missed
Okay.
all the benefits.
So, and that brings us to the most important question, which is the crux of the matter. You have to do it. What is it? So let's assume that okay, I've listened to everything you've said. I now know I have two paths that I have to execute in the next 2 weeks: global allocation or a specific allocation, in order to clearly identify how I'm going to be doing cost basis on the way forward. Uh, what do I do and how do I do it? So let's start with what. First of all, let's not go to the 37 wallets. Let's assume that I have four, right? Keep it a bit more realistic for the everyday person, right? I have a couple of things on an exchange. Maybe I've got some staking. Maybe I've got some coins left over there. I have a couple of things on a custodial account. And I have a couple of cryptocurrencies or a handful of cryptocurrencies in a software or hardware wallet that is self custody. What exactly do I need to do? And let's assume that I've been paying taxes over the past however many years. Um, and in this scenario, I've been using one of the software platforms to do it. For example, Bitcoin.tax and or one of the others. And I've been using a specific cost basis methodology. Yeah. And let's, for example, purposes, say it's not FIFO, which is the obvious one. Let's say it's highest price first. But I've been using that consistently for the past 5 years. I've been using it consistently every year. What do I need to do in the next 2 weeks?
That is an excellent question. So first of all, there's three simple things that I think it boils down to set yourself up to make this, to simplify the exercise and to have the best result when you're done with the exercise for the documentation. Because that's what you want to get. You want to get you're looking to document, right?
Okay.
Like a table and so on. Maybe some memos that go along with it. So
Okay.
number one, I would say is consolidate your assets. So if you can, this is the goal. I'm not saying you get there because there could be several reasons why it doesn't make sense. It's a cost benefit analysis.
Yeah.
Everything is. So that could be consolidate all of your assets into a one asset type into a single wallet. So it doesn't have to be that it's one wallet. It's just that you have all your BTC in one wallet, all your ETH in another wallet, and so on. So it's not so
And
much.
and and one is better than two, but two is better than five. and 5 is still better than 37, right? So any
Exactly.
degree of
Exactly.
consolidation is going to massively reduce your workload.
There's all kinds of reasons why you can't hit that. It doesn't make sense to security purposes. You could have a whole episode just on that alone. But
Yes,
yes, that's exactly right. So the goal is to consolidate as much as possible
right.
based on the amount of time you have and other factors, because
Great.
that's going to make the documentation exercise is going to make it much, much easier,
So
right?
that means, and let me get it very clear here. Consolidating into fewer wallets, not changing asset types. Because if I understand correctly, if I would say, okay, I'm going to make everything Bitcoin. I'm going to sell my ETH. I'm going to sell my Doge. I'm going to sell my whatever, and I'm going to turn it all into Bitcoin. Well, now I've just created a whole bunch of taxable events, and that could have bad implications. You're not suggesting that. You're saying simply, I have my Bitcoin, my ETH, my Doge in 5 different wallets each, and I want to have one wallet for Bitcoin or two, one wallet for Doge or two, one wallet for ETH. So I'm reducing the number of wallets, not the variety of assets, and I'm not converting or selling or exchanging assets to different types. I am simply moving them, same type, to a different wallet so that they're in the same wallet. Is that correct?
I think yes, I think you're spot on there. So and again, another way to spin it or to explain it is to say, okay, if your assets are BTC, ETH, Sol, and AVAX, okay. So if you boil it down to 4 wallets, so BTC is in wallet A, ETH is in wallet B, AVAX is in wallet C, and Sol is in wallet D. That's the goal because you have one asset in one spot.
And you
Simple as
haven't
that.
created any taxable events. You haven't
Correct.
bought or sold or exchanged or traded. You've simply moved, right?
That's right.
Okay, great.
Okay.
So consolidate is step one. Consolidate. Great. Got it. What's step two?
Step 2 is remove all assets from centralized exchanges. And as we know, that's already a standing golden principle, right? For self-custody. However, there are reasons to have some assets on exchanges. Again,
Yes.
I'll not get into that here. But if you do have assets on centralized exchanges for whatever reasons, remove those assets in the process of consolidating. Okay. Say, well,
If
what's
you
the reason?
can.
If you can. What's the number one reason for doing that? The number one reason there is because what's going to happen because of the reporting that we just talked about in the universal method and where you explained that when you sell tokens from one wallet, it might be that the call space that ends up being applied is from a different wallet. Okay.
Mhm,
So in that
mhm.
scenario that you've explained and we've discussed, what that means is that centralized exchanges do not have no idea what your cost basis is because that
Yeah,
resided previously, universally, in your crypto tax software. The exchange has no idea. So whatever
right.
records they have are wrong.
Yeah,
So what happens when they report? When it comes time to issue the first 1099 DA, what's going to happen? That's whatever shows up for cost basis is going to be wrong, and then you end up in a perpetual mismatch conundrum where it gets
right.
mismatched. Then that's reported to the IRS. You know it's incorrect. Now, how do you resolve those two? How do you reconcile the two? That's a whole nother issue there. Being able to
It's
reconcile.
he's
The way you
it's
eliminate that
he
is
said, he said. Yes.
he
You've
said,
got,
she said.
yeah,
You got to go through that. Then that's going to create a whole nother issue. Because now it's you, hey, Coinbase, you reported that incorrectly. Hey, Kraken, you reported that incorrectly. So what
right.
you do is this is what I call call spaces cleansing. So removing
Yes.
from the exchanges specifically is call spaces cleansing. Remove those assets from the exchange in the process of consolidation. You could even call it a different consolidation strategy, but as a specific reason, as I just explained. Then after you've done all that, if you want to later move it back to the exchange for whatever reason, then we know if you're going to sell it, you do that anyway. But selling it for fiat, let's say. But if you move it back to the exchange, what happens is the exchange in that situation has no idea what your cost basis is. They assign a zero to it. Okay.
They do.
Now, yes. So even in the case of Yeah, so anything that did not reside on the, did not, any sales or other activity that did not originate on that exchange, they would not know what it is. They'd have to assign a zero. So if you take it off, cleanse it, put it back, turns into a zero. And so you still have the lesser of two evils, which is it's better for the exchange to, at some point in the future, report a zero basis than to report some other number that's incorrect. You follow me?
Yes, but do you still have to contest that zero so as not to pay gains on the entire value of the asset?
Yeah, it's not, yeah, I guess it's not some, yeah, it wouldn't be so much of a contesting there because zero implies that there's
They don't
gonna
know.
be a number and you're gonna say what the number is.
Right. It's not
So,
zero, it's null. It's no
oh,
idea.
yes.
Right, I see. Yes. So so
So,
the IRS knows that if they see a zero cost basis, that could also be interpreted as we don't know. It doesn't
correct.
mean you bought this for free because obviously there is no way to buy something for free. So if there's a zero cost basis, that doesn't mean the cost basis was zero. It means we don't know. And the IRS knows this. And so
That's
it's
right.
no longer a contesting, it's providing the missing information.
That's right. And that's a far, far better scenario
Very
than
good.
some other number that's not correct.
Right, because that other number is a number and you haven't provided a number so far. And so a number is better than no number, and the IRS will take it. And now you have to persuade them it was wrong rather than they don't even have one. Got it.
That's right.
Okay. And what's step three?
So step three is for those people that are on the spectrum of all the different things you can be involved in crypto. So if you're involved in liquid staking and all these other kinds of things, DeFi, being liquidity provider, all these other more complicated things. So if
Yeah.
you happen to be involved in that, what I say is the best scenario is to unstake, split your LP positions apart. So get it down to single assets. And again, you could say that's another consolidation step, but you could have, I mean, with in ETH today, there's all kinds of these liquid staking platforms. So you could have
Okay.
ETH that's now, easy ETH,
Simplify
X, and so on and so on and so on. So you want to unstake those and then
and
get
turn
it
them
down
into
to
pure
native asset.
assets. Simplify into pure assets.
Simplify into pure assets.
Okay, consolidate, remove from centralized exchanges, and simplify into pure assets. Forget yield and staking and income generating and whatever. Just turn it into a simple base asset. Go back to the basics. All right.
That's right. And one of the number one reasons is because you have the software conundrum, and the software was already lacking in a lot of features and capabilities as it is under
Yeah.
Universal. Now you're asking for 10 times the complexity for a software that wasn't robust in the first place. That's
Right.
one of the number one reasons here.
Okay, great. And all right, so we do these three steps. Then what?
Well, after you do those steps, then you want to make sure your software is refreshed in the case where sometimes, whether it's sometimes these things may be automatic, but sometimes there's literally a refresh. So you want to make sure that the crypto tax software is now reflecting all the activity you've done through this consolidation exercise. So once you get to that point, most software will have the ability for you to export an ending balance report, whether they call it ending balance report or an ending inventory report or whatever they may call it. That's what you want to report. Now, if you've already done that, if you've already gone through all these exercises as of today, let's say
Yeah.
today you magically were able to perform all these things today. And then now you're at the point where you're pulling this report down. What you don't want to do is then have any transactional activity between now and the end of the year, because then you have to
Right.
do it all over again. So there's a bit of a timing issue where you got to kind of put a pause on things
Right.
to do this exercise.
Okay,
So
so I'm a fairly uncomplicated investor, both for our theoretical scenario here and also in actuality. So I only have a couple wallets. They're all self custody. So effectively, I'm already at the end of this. I've already done the three steps because That's just how I operate. So I've consolidated. I've never had anything on centralized exchanges unless I was actively trading that amount, and then simplified. Great. So now I go into my software and I export an ending balance and inventory.
That's right.
And okay, so very important question for you here, because I have experienced this myself. Um, what if that ending balance and inventory is incorrect?
Well, that's a whole nother issue.
Yes, that's a whole other issue.
Well, yes, and because the thing is, it's most likely not going to be correct. Whether
Right.
it's a small degree or a larger degree, again, that's back to what I call the software conundrum in the first place. I
Okay.
mean, look, I've seen some software platform will also give you a dashboard that's like, here's here's the current value today, and there's
Hmm.
your cost basis, there's your unrealized gain. So it's kind of a view of like where you stand, right?
Right.
I've seen dashboards where it's like, oh, wow, look at that. That's actually more correct than it is. It's sorry, that's actually more incorrect than it is correct
Right.
because it just doesn't track well. And again,
Okay.
a lot of times that's where they got more complicated scenarios. But anyway, yeah, that could be, again, you're just going to want to document this, right?
All right. So I can see two scenarios in which it will be incorrect for a number of people. So scenario number one, which I think is very, very common, is people have lost. So the software thinks, based on purchases and things like that happened in the past, that you have, let's say, half a Bitcoin that is that was on FTX. Well, no, I don't. That blew up in everybody's face. So I suffered a rug pull. Or I had 5 Bitcoin on empty Gox. My tax software thinks I still own that, right? Um, Maybe they haven't previously matched it to one of my transactions, so they think that's part of my cost basis. But that was lost when empty Gox went belly up, and I'm never going to see that again. So the software actually thinks I have things that I don't. What do I do with that?
That's correct. And there could be a whole host of other reasons, but you've
I
nailed it.
think that's one of the scenarios. The other scenario that's also going to be very common is people have lost keys or wallets that they previously had, where they moved stuff that they bought on an exchange, for example, and then lost the keys. And maybe they've forgotten about that and they've moved on and bought some more crypto and moved it into other wallets that they haven't lost the keys. So the software still thinks that they have some buckets that no longer exist because they got vaporized in that boating accident. Non ironically, like, people have lost a whole bunch of crypto that way.
That's correct. And your scenario, the more simplified scenario, as you said, you can give a high five to, wow, simplified self custody is paying dividends now because it's like
Yeah.
you're 9 steps down the road to start with, right?
Yes, exactly.
So
Yeah.
in this case, what you would do is, first of all, if you achieve one asset in one place, okay,
Hmm.
well, then you know that all the call spaces that you have goes as assigned to that. Then it starts simple. I have 5 BTC. All the call spaces for that is in the same wallet. That's it. And then it just becomes all the dates associated with that call spaces are also in that one spot. So that takes
Right.
care of itself. So if you think about it, where you have a column, right,
Yeah.
and it's wallet, and then it's number of coins and call spaces, and then you have another column where you could say actual. One could be, say, software. Next column could be actual, and you could then go verify to what you actually have, and then you
Hmm.
could put that in there, and
Right.
you could even calculate a difference column. Now, if it's a minor difference, there's almost always differences anyway. But if there's a minor difference, that's not going to be an issue. If there's a larger difference, you want to document it. But the key takeaways here is document what the issues are. So not only are you doing a objective kind of analysis with numbers and numbers, dates, asset symbols, and so on, token amounts, but you're also doing a memo to describe any of these issues along the
You're
way.
putting a stake in the ground here, and
Yes.
that's part of this exercise, is drawing a line and saying, at this moment, Now it's all being simplified. Everything stopped moving. At the end of 2024, this is the report. Um, Good, bad, correct, incorrect, whatever. This is it. And I'm going to put that line there
That's
and
right.
use it. Okay, great.
And so the thing is, if you have a big difference, like you said, all those scenarios you suggested, now again, the challenge comes back to, oh, well, I'd like to make an adjustment here to make these two things match.
Right,
What's actual? What's in the software? What's the issue there? Well, the issue is the tooling's not there. The feature set is not there to make adjustments.
right,
In some cases you can, but then the byproduct of that is it creates a bigger problem. So it's
right.
like, which problem do I go with? The difference that I have, or try to plug it, make an entry and fix it, which could create a larger problem and a different problem.
Okay.
So again, we could go into the weeds on that thing. But again, I think the best thing to hear is
Do you
next.
need to fix those things before the end of the year? Um, those are simply documenting the state, right? You have once you've simplified, consolidated, et cetera, and produced the report, you don't actually need to. I hope you don't need to fix the report before the end of the year if there are discrepancies, or do you?
Well, the idea would be if you could fix it in some way, fix it. But the issue is fixing is you're basically, I see it as metaphorically handcuffed in the fixing. You're
Right,
limited in your ability to do the fixing. The best thing to do is document it. Document,
documented.
document, document.
Okay,
Right?
great.
You got the
Now,
subjective memo piece, and then you have the numbers piece. And the key, one of the other big top three key takeaways of the day is, and this is always true and always applies to everything you do, okay,
mhm,
especially in, let's say, tax compliance, which is act in good faith, make a reasonable effort right here with this exercise. They even say it in the RevProc. IRS says make a reasonable effort to do this,
right.
okay? And do the
Act in
best you
good
can do,
faith.
because at some point you can't do better than the best you can do. If you say, hey, I did all this and I got these differences, I've documented everything, and then you say, I can't fix it, I've tried fixing it, it doesn't work. It's like, okay, well, I'm just going to stick with what the software says. I've documented everything. You can't do better than the best you can do. And that's it.
Right,
So there
right.
you go.
I think that's a really important thing. And, that's obviously different in the United States than it is in other countries, which is that, at least in my experience, they don't tend to go after people for making honest small mistakes. What they care about is someone who is deliberately making mistakes or not even trying to do the good faith thing. If you do the good faith and you do the reporting, mistakes can be figured out. They're not really looking for that. And fortunately, and I think this really helps us, is there are actually a whole bunch of can I say idiots who are going out there and doing such blatantly criminal tax evasion things as to fully occupy the time of the IRS. Um, and they're fully occupied going after them and not trying to go after people who are making an honest effort to do this. Uh, all right, so now I noticed in your newsletter, um, in terms of producing the documentation, you've produced this final export, and you suggested that it would be important to um, save that in a way that you can demonstrate that that was saved on or before a certain date. I had a bit of a quibble as to the methodology you used for that. I can't remember what you recommended, but I have some other recommendations. Maybe we could discuss that.
I would love to hear your recommendations. I was
Okay,
gi- I was giving the most simple one that I thought most people would probably do, but I would love to hear other great recommendations on it. But
so
what it comes down to is, well, let me just one final thing to close the loop on that. So you're going to do this documentation, you're going to do the best you can. Again, the consolidation is going to make this simple, so that way, as we explained, you got one asset, all the cost basis goes with it, and everything like that. So you've now got this spreadsheet because likely it's going to be in a spreadsheet. You save it. That's your documentation. Okay. So even in the case where, like you said, you might have somebody who's a 10 of 10, they say, hey, all I have is Bitcoin in one wallet and I actually have I actually have it. Like it's already there. Am I
Yeah,
good? The question is no. What I would do is file save as because that's declaring that this is the document for this exercise.
right.
And you
Yes,
retitled it. Maybe you put the title even at the inside the document. You've titled the
yes,
document.
yes.
File save
Year
as after
2024
documentation.
final ending balance safe haven report.
Correct.
Dot
Like that.
XLS. Yes. Okay.
I said email it to yourself, so go ahead. The ball's in your court. What can you do
So,
better?
so what is the goal of emailing it to yourself? Let's clarify that. Your recommendation is certainly a reasonable recommendation to achieve the goal. The goal is to create a timestamp, and that timestamp shows that that document existed on or before, and it's also stored securely. Um, the only thing I would be hesitant doing is the following. Most people use a custodial email provider like Gmail. I don't know anyone who runs their own mail server anymore, even the hardcore geeks. The problem with that is that it creates a very significant privacy risk, because then you have a spreadsheet with all of your assets sitting on a mail server, probably Google's mail server, that is being actively harvested to train AI, and is being harvested for all kinds of data analytic purposes by Google. They take the stuff that's inside the attachments and they build search indices on it for your Google profile. So I would be worried that if someone compromises your email account, now they have access to your entire asset list. Um, and at
I'm
least,
with you 1000%. I guess if you're
yeah,
gonna email, I'd say Proton Mail if you had to email yourself.
yes,
Or
that
sorry.
would be if you happen to use Proton Mail. I know a lot of people who are more security minded. I was going to make a different recommendation, which I think is equally effective. Um, we need this to last 10 years. So sometimes old school, it works just as well. So for the timestamp, I would like to recommend a solution called opentimestamps.org. Open timestamps is a open protocol that uses the Bitcoin blockchain to timestamp hashes, fingerprints of any sized information, and it's a completely free. And it's a completely open protocol that even if open timestamps went away, there are command line clients, the software that implements the protocol. It's not dependent on any single provider. What Open Timestamps does is you load it in your browser, and then without sending the information from your browser to anywhere else, you upload a file, but it doesn't actually upload it. It simply processes it in your own browser window locally. And what it does is it calculates a SHA-256 fingerprint of that file. And then it queues just the fingerprint, just the SHA-256 fingerprint, for inclusion in a Merkle tree on the Bitcoin blockchain that contains other timestamps that other people are trying to timestamp. And every 10 minutes, it puts one transaction which has tens of thousands of file fingerprints that people are trying to timestamp. And then it gives you a proof, and the proof is another file. It's an open timestamp file. And it has the same file name. So let's say you called your thing final ending balance 2024 IRS safe haven.xls. You put that in you go to opentimestamps.org, you click upload. Um, it, it, it then gives you final 2024 IRS haven dot open timestamp.
Hmm.
You can then take the spreadsheet, the XLS file that you timestamped, and the timestamp file that it provided, and you can use those to verify, and it will show you a proof that that file was included on the Bitcoin blockchain on December 27th at 10:59 p.m. And here's the proof. And that proof is recorded forever on the Bitcoin blockchain. So you've got a timestamp. That timestamp is based on the fingerprint of the file, and the proof is a file itself that anyone can verify. was included. Really nice protocol. I think Peter Todd built the first prototype and proposed it. It's a great system, and it allows you to timestamp. Now, the most important thing is the spreadsheet that has all of your balances never leaves your computer. It never goes anywhere. All that goes to the Bitcoin blockchain is a fingerprint. And as we know, the SHA-256 fingerprint is non-reversible. You can't get from the fingerprint to the contents of your file. That stays with you. You then end up with two files you need to store, the spreadsheet and the timestamp verification file that you can in the future use to prove. And those two files you can put on two USB sticks and stick them in a safe deposit box or in your safe, and put a copy on your own computer, and keep them. So that would be my recommendation.
That is the I think that's best practices and the number one method for getting
Great,
this.
thank you. I'm glad you like it. It's super easy, and people can execute it. It doesn't require any technical skills. You go to a website, you upload a file, it gives you another file. It's really simple, and then you store both of those. opentimestamps.org is the website you want to look up. All right. With that, I think this has been a long introduction, but we've actually covered a lot of things. So what I would like to do is I have a bunch of questions that have been submitted by the subscribers to my Patreon, who asked questions about this whole conversation. I think we've already answered many of them, but maybe we can quickly go through them and just confirm some of the answers we've already provided, or provide new ones. How do you feel about
I think
that?
it'll help reinforce what we've talked about.
Great. So I'll go and ask you the questions now. So the first question was, what are the consequences of not getting Safe Harbor? Would that restrict reporting to FIFO only? So from what I understood, what are the consequences of not getting Safe Harbor? You've already said you're going to have to do this anyway, and you're going to do it in a much more complicated and disadvantageous way if you don't do it now, right?
That's correct. Plus, you're losing the possible protection of being challenged for all of your prior activity.
All right. So let's focus a bit on the second part of the question, because I'm not sure we answered that. Would that restrict reporting to FIFO only? Does any of this change which cost basis method you can use?
No, it does not. That does not affect FIFO. And as a matter of fact, this is another thing that I've identified as, I think, a missing benefit, or something that's just not being talked about or covered inside this conversation, which is that this actually gives you the opportunity to potentially make a cost basis methodology change inside of going through this exercise. Like, I go through it again, stake and sand. I've done all this work. You know what? I used to use that method, and now I want to use a different method. This is a great time to say, hey, I want to make that change, because you've teed it up to do it.
Oh, so you get a free reset.
A free
You
reset.
Oh, that's really, really cool. Okay.
Nobody's talking about that. That's a huge, huge thing.
Right. So maybe you were doing FIFO before, and maybe you want to do highest price first out starting January, and the Safe Harbor, you feel confident, gives you that context to make a change.
Yes. And, I want to make sure to insert something now, because I don't want to make sure we don't forget it, even though it may be answered with the other questions. But the thing is here that's also super critical, and again, could probably even go into a whole, go way off into the weeds on this and have a whole nother talk on it. But the thing here is, with specific identification going forward, the challenge is that you need to identify ahead of time, declare, this is what I'm selling. So this particular lot, it's Bitcoin. It's this amount that I purchased way back when. And that's what you're going to do. So stuff we already talked about what the methodology is, but you need to actually declare that. And again, put a stake in the sand. It will be like doing opentimestamp.org every single time you want to do a transaction before you actually do it, and then go do it. Because you basically blow qualifying for specific spec ID if you do it after the fact. But it's an after the fact exercise anyway. The software is not designed There's
Right.
nothing that's designed to do and document and capture this stuff ahead of time. So that's a whole separate thing. Is how do you
Okay.
manage Spec ID going forward? But you may say, wow, that's crazy. I don't see how I can comply with that. And I
Yeah.
don't think there's anything that's going to come out that says, so you might say, well, that's my compelling reason for going to FIFO.
Okay, very good. So if you were doing spec ID, it might get very complicated going forward. And so specific identification is where each time you make a sale, you match it manually to the most advantageous cost basis that you want. And people were doing that because they wanted to pick and choose with every sale, but they were doing it after the fact at the end of the year as part of their reporting. Going forward, that may not be possible at all, which means that specific identification as a methodology may become super cumbersome because
Correct.
you and possibly get you into hot water. And you're saying the safe harbor gives you an opportunity to change your methodology, because this is the advice I got for many years from many accountants, which was it doesn't so much matter what cost basis methodology you use, FIFO, LIFO, HPFO, or specific ID, as long as whatever you choose, you then have to stick with it and not change it. And that's what I've done. And you're saying, and now we get the once in a lifetime opportunity where you could do a reset on that if you want to a different methodology. So take that
That is correct.
opportunity.
That is correct.
And
And yeah,
specific ID may become so much more complex that this might be a very good time to do that.
that is correct. And another thing you could potentially use to your advantage is where HIFO, for example, you might say that that's like a pseudo spec ID. Okay. Like you could
Yeah.
say it's not specific ID is, again, whatever I want, wherever it is at whatever point in
Mhm.
time. HIFO is a methodology, highest in, first out. But you could say, I'm just going to use that. And that's somewhat what specific identification was. It's the quasi is the better word. It's like a quasi
Right.
spec ID.
Yes.
So you could say, you know what, because it's very challenging to do this going forward, you could just say, all right, before each trade, I just say, I'm going to do highest in, first out before
Yeah.
each trade. You just declare it's almost like a standing order in a way.
Right. I see. Okay.
So that could be a way for you to, it's a little bit of a hack, if you will, as a way to achieve it in a simplified way.
I see. Okay. Second question is wallet here defined as all addresses controlled by a wallet, the piece of software or hardware that we're using, or is it one wallet, one address?
That is an excellent question. I'm glad we have addressed that because in this case, so let's take Bitcoin for example, or if you had a wallet where you were able to do a new address, one address per one transaction. In
Right.
that particular case, that's just the wallet is one. That's the container. All the activity in that wallet is one container. That's it. But on the
Okay.
other hand, you want to compare that to MetaMask, for example, and you got MetaMask set up, and then you can create multiple ETH accounts in there. Okay,
Hmm.
like it's kind of like account equals address on
Right.
Ethereum.
Hmm.
So in that case, it would be each of those accounts is actually its own wallet, so to speak, its own accounting. That account
Right.
owns separate thing. Okay, because you could have one MetaMask that has 10 accounts, or you could have 10 MetaMasks that each have one account. So it's one account is where you need to account for in that scenario.
Okay. So I think what I'm understanding is there is no clear rule that really says what a wallet or an account is, but it's more about, can you plausibly categorize things that are controlled by a single set of, for example, let's say I have a, a Bitcoin wallet that is all generated from a single seed. I can make a very good argument that that is one wallet because all of the keys and addresses and everything else is generated from that one seed. If I was using that hardware wallet to do Ethereum, again, all of the keys and addresses are generated from a single seed that I'm managing from a single device. That's a fairly convincing argument that that is one wallet, right? But it gets murky if you have different pieces of software and different key material that is controlled in different ways. It gets a bit murky as to what exactly a wallet is.
Yes,
Okay.
that's correct. And the other thing to overlay with that is like you've got these situations like you're describing, but then it's okay, well, how does it show up in the software? Because if the software is containerizing it as a separate thing,
Mm-hmm.
then that's you could like work backwards to say that that's what I'm going to use as my definition.
Right. And I'm thinking that, from my perspective, for example, I'll use a single seed, and that seed will generate legacy Bitcoin addresses, SegWit Bitcoin addresses, nested SegWit Bitcoin addresses, Taproot addresses. I may then send that to an exchange. They don't really pay attention to what type of address it came from. It's all from the same wallet, but it might be contained in different types of addresses.
Right.
I would
That's a
make the argument that's one wallet.
that's a great example where in self-custody it's in five little buckets, but when you send it, if you sent something from all five of those and to the exchange, it goes from five into one bucket.
Yeah.
Right. So, but again, if that would be where if you've got those different types of Bitcoin addresses, then and you're putting it in the software, you probably would need to put the five different ones in there for it to pick it all up and bring those
Yeah.
transactions.
Yeah. I would say this probably falls under the make a good faith best effort in terms of consolidation, and then be consistent. And hopefully then you can make the argument, if it ever comes up, that that's what you were doing, making a good
That's
faith consistent effort.
that's
All right.
right. That's a key takeaway, by the way, there, just to highlight that word when I talk about reasonable effort and good faith. Consistency is another key thing. Always be consistent. It's an accounting principle, actually.
Right. Excellent. What crypto accounting software best accommodates this one-time allocation requirement or opportunity, this safe harbor? Is there any software that has actually been able to adapt and prepare itself to do this for you or help you with this?
Well, my immediate answer is none. But
None.
that's
Right.
but just going along with everybody over time is always wants to know, hey, what's the best software in general? Forget about at this point in time. Go back in the past.
Yeah.
Hey, what's the best software? The answer is none. It's like, what's the lesser of the evils? And what are you
Right.
trying to achieve? What's the best one that fits your use case, and so on and so on. Now, with
I
that said,
think I have a good answer to this. I think I have a good answer to this, which conforms with your accounting principles, which is it's the software that you've been using for the past several years, good or bad. Now is not the time, I don't think, unless you have a compelling reason to throw that away and start fresh, right? Or is
you
this a good
nailed it.
opportunity? Yeah.
No, you
Okay.
nailed it because now you're introducing having to go through the allocation exercise that we've talked about, and you're going to try to do a migration. Now you've like
Right.
doubled the complexity
Complexity.
or more.
Right.
Yeah,
Right.
you don't want to migrate and then try to do this at the same time. So it's yes. So what's happened here is you've gotten relegated to using what you already have. Now, with that said, there are some like a coin tracker, for example. I know that one specifically. They saw this coming down the pipe and they started at the beginning of 2023 and said, hey, we're going to lock these wallets down. We're going to like take whatever is in there. We're going to like lock it and assign it to a wallet and so on. Okay.
Yeah.
So uh, and again, that's another question people would have was like, oh, well, in the rare case where the software might have done it, is that my work product? And
Right.
the answer I'd still say is no. You still want to, you still need to spit something out into some type of document that says this is the work product, the work paper that I did.
Right, because
That's what I'm-
also you can't leave this on somebody else's website. You have to have your own copy because it
yes.
is not their burden to produce this. If they go belly up, if they disappear, if a fire consumes their data center and they don't have any backups, whatever, and suddenly that website doesn't exist, you have nothing. So always produce those reports. Okay, great. So If you have never filed taxes on crypto before, you have a bigger problem. In that case, you have a blank slate to pick whichever crypto tax preparation software you want. But if you have already picked one, you stick with that one. So what do we need to be careful to look out for if we've been using tax preparation software for some time, and especially if we are making changes from HIFO to FIFO?
That is
Any
another
pitfalls?
that's another excellent question. So the thing here is, I'd say probably one of the number one things that sticks out is that let's just use go back to the universal, the way this has been done up until this point, like we've been talking about, universal accounting method for tracking. So what happens is every year that you go in, so if you started in 2015, you get all your transactions in there, you do a calculation. Okay, now you're in 2016, the new transactions are updated. When you do 2016's calculation and 2017's calculation and 2018's calculation, every time you do it, it's recalculating everything. The one giant pot of transactions that we talked about, it recalculates everything back to the beginning of time to produce the result for 2018. So every year is actually inextricably linked to every other year. They're not done in isolation. And another thing you can't do, you can't say, hey, HIFO worked great in 17. FIFO worked better in 18. I'll just pick whatever one gives me the best result. You can't do that. Consistency, got to pick and stay with the same one. So the question is, if a software claims that they're doing some type of a feature change, what you need to understand, and again, this should be published, but again, I don't know that it would be published, but I'd be skeptical if it does get published, but you need to understand, is the previous work being locked down? Okay, such that when I do my calculation for 2025, is it only looking at my fresh starting point, again, the goal of the exercise we've been talking about, or is it going back in time and recalculating everything all over again? So it's like, is there a lockdown like that? Because there's nuances with that around the software.
Yeah. And I remember distinctly that one of the features in the software that I happen to use is that once you're done with a year's calculation, you can press a button that says lock. And that's exactly what it does. It doesn't allow that year to be recalculated. And I'm assuming in the background, it doesn't allow those cost basis allocations to be changed for whatever was calculated there. And that's a cool feature. All right. And so in terms of pitfalls, if you are changing from HIFO to FIFO, this safe harbor ending balance report that you produce is your way of, on your side, locking things down so you have a clear starting point, regardless of what the software is doing.
That's right. Now, again,
Okay.
you want these two things to, well, obviously, you want them to be the same, or
Yes.
you want the differences to be as small as possible. But
Right.
yes.
Okay. Next question is, I have purchased Bitcoin from 3 major exchanges and BISC. For those who don't know, BISC is a decentralized exchange. For privacy, most of these funds were coin joined using Wasabi or Samurai and then placed back into cold storage. I keep a record of my purchase history in Excel and have never sold or converted back to fiat. This is quite a hodler we have here. Based on the guidance in this article, is this sufficient for tracking, or must I make a report before the deadline?
Yeah, that's a great use case scenario, an example to pull from. And I think we've already touched on it, but it's important to highlight this again, where this is a scenario where what I'm getting is we have one asset, Bitcoin, in one spot, a hardware wallet.
So they've already done the consolidate, remove from exchanges, and simplify steps. They're past that. They already have a report. So they're 90% of the way there, but they still have to do something.
It's almost 10 of 10. But it's back to the one. So maybe we'll say 9.
Yes.
And the reason it's 9 is because, again, it's like, oh yeah, I actually check all the boxes. I've kind of done all the work, and it happened to work out for me that I fit all these things that I need to do. So, but again, what you need to do, that was where I would open it up, file save as. There's your report, but put the title on inside the document at the top, and then file save as and rename it.
Create a specific copy at this time and then timestamp it using opentimestamps.org. So you still need to do the drawing of the line in the sand. You're in the correct place to draw the line in the sand. You have everything ready. You still have to draw the line. And the way you draw the line is make a separate copy that is not going to ever be modified. So lock it down of that report. And timestamp it so that you know, so that you can prove that that report was made at this
That's right.
time.
And then
Okay,
that
great.
case study example, that's the absolute minimum steps.
Yes,
That's what the
yes.
example.
You're very lucky if you're in that simple solution. All right. And then I think there's another really very specific scenario. I've only ever bought and sold on Coinbase. I have a good record of those. I've reported gains on sales and purchases and used FIFO. Specific lots would be helpful now for my situation. What do I do under the safe harbor to facilitate that? In factoring, I have mostly self-custody on multiple wallets.
Right. So this ties into what we just said, is where one of these things that's not being discussed here is it gives you also a unique opportunity to say, hey, I'm going to change my cost basis method. Okay.
Yes.
Now,
But in this particular case, they're suggesting going from FIFO to specific lots or specific
right.
identification, as you called it. And you said that's going to be tricky in the future because you're going to have to pre-allocate before you sell every single time.
That's right. So this is he's actually asking the opposite of what we pointed out,
Yes.
essentially, as an
Yes.
example. Switching. Now, with it being said that specific identification, we would have challenges around this, but the thing is the benefit of that methodology can be so great
Yes.
that you say, I cannot give that up. In
Right.
other words, the power to pick and choose my gains and losses. See, with FIFO, that's what you're giving up here. This is an important point.
Yes.
You're just saying, I'm at the whim of the methodology. But with Spec ID, you say, I have the power and control to determine the outcome of my gains and losses. So you got
Right.
to decide whether you want to give that up or not. And again, yes, if you go down that method, decide to make that switch, FIFO, Spec ID, then again, maybe it's toggling the software to HIFO, and then it's more or less you do a standing order where you just say every time, again, figure out which way to document before the trade, because it has to happen before the trade.
Mm-hmm.
And then just say I'm selling highest in, first out in that wallet.
I see. Yeah.
And that way everything matches up. You're achieving, the software matches what the outcome is, and it's as close to specific identification as you can.
Okay. So it's going to be a significant accounting cost and it's going to be a significant burden, but there are circumstances in which that is more than worth doing, depending on how your cost basis is. So how do you do it? Document, consistent, and good faith. All right. I bought Bitcoin on behalf of family members via their verified Coinbase accounts using their funds and moved it to shared cold storage, all stored on the same hardware wallet. It hasn't been moved in years. If I use first in, first out and their individual Coinbase histories to report any sales on their behalf in the future, could the shared cold wallet situation cause tax issues?
So the answer is yes. And not only does it cause tax issues, this is a commingling violation. And I
Yes.
say never, ever, 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 ever commingle.
You're
That
basically acting as a broker on behalf of your family in this particular
you
case.
could have that could be an issue. I mean, you could go down and you could have a whole case study on this scenario right here and talk about all these different things that come up with it. But first of all, commingling in fiat is already a nightmare.
Yeah.
Commingling in crypto is multiplied times 10 or more. Pick your multiple factor on that. So what I always like to say is it's like the metaphor is you're in the kitchen about to bake a cake and you got all the ingredients. You got the chocolate morsels and the powder and all the things it takes to bake a cake. And then you mix it all up. After you mix it up in the mixing bowl, guess what? You can't unmix it. It's
Right.
mixed together. And that can happen in crypto. I'm not saying there are scenarios where it's like, oh, based on the specific facts and circumstances, I can unmix it, but that's actually more unusual. It's usually the cake batter where you mix it together and you can't unmix it. So,
Right. And
but
yeah, and one of your
so
relatives is allergic to peanuts. So
so
okay, so
it could be difficult to it could be very difficult to peel that apart. It's just there's a no-no there for many reasons, inside and outside of the context of this conversation anyway. So don't do that, and it could create several
but
issues.
but at the same time, I think uh let me suggest a hypothetical here and you tell me if this might work. The safe harbor has now provided a really nice opportunity to potentially clarify, document, and draw a line under this mess in a way that will prevent worse problems happening in the future. So previously you suggested step one is consolidate. Maybe in this and only this narrow scenario, you're like, okay, there's 5 family members. You actually still have the Excel spreadsheets, you know what the Coinbase histories of these accounts are, so you know what each person's balance is. Maybe this person's first step is unconsolidate, create 4 or 5 distinct wallets, move each family member's balance into that distinct account in a wallet. You can keep them on the same hardware wallet, but you use this opportunity to spread them apart and put the balance in each one, separate them out, do all of the reporting with the cost basis for each one with 5 different ones, draw 5 lines in the sand, and the safe harbor, I don't know. This is probably a perfect opportunity to undo that mess.
That is a perfect analysis. That's your crypto bullseye right there. Exactly.
Yeah.
That narrow case, as you described it, will be one where it's your opportunity to clean the mess up, solve the exercise all at the same time. So if there's 5 family members or whatever it is, and that's all in the one hardware wallet, then it's time to set up the 4 other hardware wallets and get those sent out, create the documentation. And what I
Yeah.
would also do is it's a good opportunity to get the family members I would create like a one pager that says, this is what this was, and this is now being sent to your wallet, and basically get them to sign off that they are also agreeing to this starting point, that this is the Bitcoin that's coming into this new wallet.
This
And
is cost
by this exercise,
basis. I
I
bought it
agree
on
that
your
this is my
behalf
amount.
then.
Yes.
Yeah.
I get everybody to agree to it, so it's black and white and super crystal
Paper
clear.
it.
Paper it.
Yeah. Okay, great. And that's actually a great question to end on. I think we can summarize this quite nicely. First of all, thank you so much for all of this incredibly detailed information. I think I've learned a lot more about the specific circumstances. This is going to be a mess. It's going to be a burden, but if you do the smart thing and you do the work in the next 2 weeks, and it could be quite a bit of work under some circumstances, um, you're only going to be saving yourself much more pain and burden later. And in many scenarios, you have a golden opportunity under this safe harbor to fix mistakes of the past, to change your cost basis method, maybe, to clarify and document what you've done in the past, and to wrap it all up in a nice bow. So you could turn this burden into an opportunity. And the guiding principles are you're acting in good faith, you're documenting everything that you're doing, and you're doing things in ways that are consistent. Would that be a good summary?
You've nailed it up. That was a perfect summary. And you're right. This is an opportunity as well. There is a benefit. Like you said, you could have, again, if you're closer on the degen side of the spectrum and you got a whole bunch of wallets and accounts on all kinds of different chains and all kinds of different assets, and it's just like, let's just say little amounts, maybe dust or whatever. It's just like, you know what? I mean, it could be like, $30 worth here and this and that. It's like a time, okay, just sell it for stable coins and consolidate all your stable coins and just have it be some dry powder for an opportunity comes along. So it's the time to take advantage of just cleaning up stuff that's just been kind of hanging around, lingering.
Right. Yeah. It's not going back up, my friend. It's it's trading for 1 penny on the dollar of what you bought it for. Take your loss and write it off. All right. So I know that you're not doing tax accounting for crypto. I'm sure you're mentoring and advising and providing us with this incredible information and helping other accountants do it. If I was, for whatever reason, needing a tax accountant who understands crypto for the first time today, and wanted to find someone for 2025, do you have any place that you would go looking? Any recommendations?
Oh, you mean you talking about looking for like a resource for where there's professionals in
Yes, yes.
business?
Where can you find professionals who understand? I know you don't do that kind of work, but where can you find professionals who can help you file your 89, 84s for next year, and deal with the IRS and any other problems you might have
Yeah, that's a
on
great
crypto?
question. So what I did is also at Crypto Bullseye Zone, I've actually created there's a page on there that's actually called Professional Resources, where
Okay,
I've
great.
curated a list of professionals, which actually I need to update and make some additions to. But
So
it's
you have
also
a directory there.
a
Fantastic. So that's
directory, yeah, create a directory. And it also, just while we're on it, it also includes legal as well, because sometimes it could be rather, you
mhm,
might be a business that wants, now legal is more uh narrowly focused. So not a lot of times attorneys specialize in a certain area. Okay.
right.
So, but it could be tax attorney, or it could be securities law or whatever. So also it's not just like CPAs, tax professionals specializing in digital assets, but there's also a legal aspect, and there's also an other category as well. And the other thing too is in some scenarios where you're dealing with some issues in crypto taxation where maybe you weren't in compliance, or for whatever reason you got a major issue, then you're talking you need a tax attorney, and you get, when you get to a serious issue, what I call is, that's where you need to call in the special forces,
Yeah.
and they need to have a tax attorney. Like, for example, we have somebody that specializes in tax controversy, meaning a serious tax issue. That's what that means.
That's where you're
And
negotiating a cleanup operation with the IRS.
yeah, so
Okay.
to find the intersection of a tax controversy attorney and someone who specializes in digital assets and so on, you're getting to a short list.
Right.
So
Right.
there's those type of resources there too. So
Okay, cryptobullseye.zone is the website. Kirk
that's
David
right.
Phillips, CPA and CBP, my good friend and colleague who has helped us today decipher the IRS safe harbor rules for the upcoming change in how you calculate cost basis for 2025 and turn this burden into an opportunity. Thank you so much for all your time today. That's all we had. And for follow-up questions, you can contact Kirk directly through cryptobullseye.zone. And you can reach me on Patreon, patreon.com/aantonup or aantonup.com on my website. Thank you all for watching. I hope we've answered your questions today. Have a great one, and happy holidays to everyone. Bye-bye.